In this example, I'm going to go through a company that's issued bonds that pay interest semi-annually, which means twice a year. So we got on May 31, the company issued $10,000. That's what they call the face value or the par value. That's what has to get paid back in 20 years, which is the maturity date. But in the meantime, it's going to be paying interest, and the rate is 6% per year. However, half of that's going to get paid every November 30th and the other half on May 31. So 3% every 6 months for a total of 6% per year. This 100 is the bond quote that is telling us that this bond sold for 100%. This is a percentage of its par value or face value. So in other words, they're going to get $10,000 because the market rate of interest is equal to the stated rate. The market's happy getting 6% for this company's level of risk. As far as the next date, let me put the dates in here, May 31. The next date we're going to have to worry about is 11/30, November 30th. And that is the date at which we have to make our first interest payment. It is half a year's worth of interest because that's the deal. We have to pay every November 30th and May 31. And it's PRT. The P again is your principal, just like with notes payable. It's very similar. Times your rate, it's 6%, but we are only having to pay 6/12 or 1/2 of a year's worth. So that's the credit to cash on November 30th. What are we paying for? Well, it's the service you got. Debit interest expense. So we had the first 6 months use of this money, and we are paying for it in the same accounting period. The next date we have to worry about, though, is we have to worry about December 31. So we've paid through November 30th, but by the end of the accounting period, 12/31, we have to record that last month of interest that we owe. Aren't going to pay until the next period, May 31, but we have to record the interest that we owe for that last month in that first year's accounting period. So we are going to be having to debit interest expense and credit interest payable for PRT, the amount of money we had use of $10,000 times the rate of 6%, but we're just recording December's interest. We've paid all the way through November. So the entry for December 31 is a debit to interest expense. We're not paying this yet, not until later, so the credit is to interest payable. So now I'm just going to show you for the next accounting period. This is 10,000. It's our beginning balance. As far as our beginning balance for interest payable, it's 50. This gets closed with all our other revenues, expenses, and dividends, so its beginning balance is 0. So now let's go and do our May 31 payment in year 2. It's the exact same amount. Every 6 months it's going to be $300, which is, again, I'm going to show you, it's P, your principal amount you had use of during the period, times your rate, 0.06 times, and again, this is 6 months. We're paying from November 30th through May 31. So we're going to credit cash for 300. What are you getting? Well, what are we paying for here? Well, we're going to get back the IOU. This is the interest from December. So we're going to get that IOU back. That's part of that 300, December. And then we have 5 months of interest that we have to record. And again, P times R times, and this is 5/12, January through May. So this again, this is December, and this is January, February, March, April, May. That's being paid. Now it's November 30th, they're going to do another 300, and it goes on in the exact same fashion. Every accounting period they make 2 payments. Every accounting period they have to record that last month of interest. And that's how that works.